Good day, and thank you very much, Stephen. So thank you for coming. So normally you hear from me for 5 minutes or so before I hand over to Caroline Bradley for another 15 minutes or so. So Caroline is currently working in the Hong Kong office today. So I'm going to talk to you for 15 to 20 minutes or so. I apologize for that. But Manus Carville and Martin Mayhew are on hand to answer any questions you may have on my speech, and I will also be around. So I spoke earlier today to the bankers, some of whom may still be here, but most of whom I think have left. And I thought the bankers needed some cheering up because it's a tough industry for them, so I included a joke. But as you will see through the course of the speech, insurance is doing quite well, so there are no jokes. At least there are no intentional jokes in this speech. Also, it is difficult to think of a joke about insurance, whereas banking is relatively easy. So I intend to start by speaking on this year's theme of corporate governance. Now, I do apologize to some people in the audience. If you're very dutiful or you're waiting for the conduct presentation, you are basically going to have the first 5 minutes along the same lines as I spoke to the bankers today. But I think it is quite interesting for the insurance people here also to see what I worked out for the bankers. I will come to that in a minute. Not least because corporate governance for insurance is quite an interesting issue in Guernsey. So after corporate governance, I'm going to comment on insurance trends in Guernsey and offer some thoughts around opportunities for the Guernsey insurance sector. Now, no seminar address would be complete without consideration of regulatory trends as they affect Guernsey, and I'm going to finish with a summary of the Commission's work this year in connection with the insurance sector. So I'd like to begin by addressing the theme of this year's seminar, the interaction of business culture to regulation. And when thinking about how that might be relevant for banking and insurance, I focused on boards, which are, I think, important, we would all agree, for business culture and regulation. And the question I had in mind was, how far are we similar to international practice as far as board composition is concerned? Because generally we do compare ourselves, for example, with the insurance core principles, and we are comparing ourselves there with global trends. So how does Guernsey look from board composition of insurance companies? There is one issue that inevitably pops up, and that is the issue of diversity, and this was asked about yesterday. Quite rightly, of course. I'm not going to address that directly. I'm more interested in the comparison of Guernsey to the rest of the world. But I would like to say one thing very quickly about diversity, and that is how I view it. The root of the word is divertere, which comes from the Latin, to cause a change in direction. And as a regulator, when I have people in front of me who want to become board members of the larger firms we have, that is the question I ask myself. Does this person, male, female, from Mars or whatever, can they actually cause a change of direction in this company if necessary? That's the litmus test. And that may be quite a useful way of thinking about it. The other thing that needs to be borne in mind is that certainly for the banks, less so for the insurance companies, but it also applies to them, they do tend to be part of larger groups, larger entities. And therefore, they may not necessarily follow the same corporate governance structure as UK FTSE 100, for example. When I looked on the internet to try to find out more about subsidiary or non-group boards, there's actually very little study being done on them. So that's it's something to bear in mind, and I think it does explain one or two of the differences in what we're about to go through. I've put a few caveats on, and I think it's worth just spending a little while thinking about those. We only have 14 bank subsidiaries in Guernsey, but it's quite easy to determine that. We have something like 340 insurance companies. So what I asked my team was to look at, can you give me some insurance company boards that are broadly comparable to bank boards or of a size and significance that would be relevant? And the first thing they said, well, we want to exclude captives because they really are unusual. And I think we all know why, because they have risk managers from the company. So you wouldn't really expect them to look like an ordinary board, and they have the insurance managers involved as well. So we ended up with only 8. It's an arbitrary number. It's a mixture of general and life, but it does exclude the captives. I'm sure the more statistically minded amongst you, certainly actuaries, are going to tell me this is ridiculous, you can't assume any aggregate from 8 or 14, and of course they're entirely right. But it's all I've got, and just go with it at the moment. But I think it does explain error factors that have to be relatively significant. The other thing I find like to say, because often people talk to me and they assume I'm in some sort of vague language that no one else can understand, that I'm passing on regulatory messages with swishes of the eyelashes and all that sort of stuff. I'm not. There are no hidden regulatory messages here. I'm not suggesting in any way that when you look at your own insurance board, you should look at these aggregates and think, oh, that's where I've got to be. Everything is different. Everything is relative. So let's just together zip through these files and see what we come up with. So here is the board composition. This is taken from Stuart Spencer. I should mention that the team also couldn't find me one comparator. They had to find me various ones. So we used Stuart Spencer, the Financial Times, and Deloitte's. So unfortunately, the comparators are not smooth, but nevertheless, I think they work. So this was from Stuart Spencer. We've got the average size of the FTSE 150. Why they chose FTSE 150, I do not know. What's wrong with FTSE 100? Anyway, they did. So you've got a board in the FTSE 150 of about 10, much smaller in Guernsey. I don't have a problem about that. We're smaller entities. We're often subsidiaries. It's not such big business, so we have smaller boards. Fair enough. It's between 5 and 7 or so. Average age of NEDs. By the way, for NEDs, I've included anyone who isn't an executive, basically. So whether they come from Guernsey or elsewhere. So the average age, interesting youngsters on the Guernsey insurance firms, 52. I'm not quite sure why that is. I think it's to do with the advocates, actually. There are quite a few advocates acting as NEDs, and they tend to be working advocates, and therefore they tend to be in their sort of 40s or so. I think that's brought that number down. But it's not a big difference. They're all in the prime of life in their 50s, a bit like me. So then we have the average age of executives. These are the people on the ground, again, in their 50s, and directors that are NEDs, similarity right across the board. I think that's quite comforting that we do have a significant amount of NEDs on the board, although, of course, I take the point some of them may be parental NEDs. So what's the next slide show us? This is from the Financial Times, and it's about NEDs. And it shows you, for example, if you look at Russia, there you can be relatively young, but you don't last very long. And then right up to the US, you've got people who've been around a while and are quite relatively old. And the banks are bang in the middle. Guernsey Insurance, because of that slightly younger profile, is a little adrift. I don't think that's anything to worry about in terms of age. But the tenure of length, it's about 7 years. It's pretty much in the middle. If you pushed it across, we'd only be a little bit above Germany and the UK, around Italy and Switzerland. So I take some comfort for that. We're sort of in the mainstream, fair enough. Well, let's look at the next one together. This one's quite interesting. We're now looking at a Deloitte comparison. Now, I don't know what UK finance sector means to Deloitte, but I imagine it means the City of London, basically. So the women serving on board is 12.3. We're a little bit below in banks and insurance firms. Oddly enough, very similar. Again, I don't see that difference as significant, really, given the error factor we've talked about. It's broadly the same. Now, of course, the United Kingdom government is looking at 25% of women on boards generally. So the City of London is well below that. Coming back, however, from my point about diversity, all I can say is that we're broadly in the same place. I think the next one is quite interesting. NED serving 9 more years. Now, you all know the Financial Reporting Council statement that anyone over 9 years as a NED is not really independent anymore. Nevertheless, there are still 11.4 in the UK financial sector in that space. It's only a recommendation, it's not a demand, and there are circumstances that you can see why that might be different. About double the level, however, again, amazingly, almost the same for insurance companies here and banks. And I think there's 2 reasons for that. I think there are a lot of local insurance expertise is not totally plentiful in Guernsey. So when you get someone who's good, there's a tendency to go on for quite a long time with them. And also, of course, there are people from parental bodies who almost have a sort of umbilical link with Guernsey and have been coming here for years and years and years. Again, I'm not saying this is a good or a bad thing, but you may want to think about those directors who have been around a while. Are they truly independent? It's over to you guys. The last one's quite interesting. I don't know why Deloitte couldn't put a number for independent NEDs. I think I'm talking here, by the way, about locals. I guess that's why it's not relevant. It's not really a Guernsey number. But we've been pushing for a long time, certainly with the banks, but it's also a requirement for insurance firms to have at least 1 local NED on your board. I'm glad to say generally average is 2. And that makes a lot of sense to me, because if you're one person in a board that doesn't agree with you, it can be a pretty lonely place. So 2, I think 2 people sort of batting for Guernsey is no bad thing at all, and I'm glad that worked. By the way, I think we had a tougher time on this one with banks than we did with insurance firms, so well done. Okay, so I did have something on chief risk officers with banks, but I don't really think that's relevant for insurance companies. But just to mention it, it's quite rare to have a chief risk officer or a chief compliance officer on a board in Guernsey in a way that's becoming very common for banks, and I suspect insurance companies in the United Kingdom as well. Whether we want to go there or not is something you may want to think about. So, moving on. These are the insurance trends for last year. Now, we have not published these yet, so these are hot off the press for you. You'll be familiar with these graphs. They're on our website. We publish them every year. I'm sorry we couldn't get them closer, but that's the best we could do. The good news, as you can see, there's an increase in gross premium again for 2015, which is encouraging. There have been a few significant deals, and it's good to see that go up a bit. Otherwise, the numbers are more or less flat. Of course, gross premium is something that most insurance regulators track. It doesn't necessarily reflect, of course, itself in gross assets or net worth due to insurance being ceded. But it's been a reasonably good year for Guernsey, 2015, particularly active last year in the ILS market. This year, I think they're coming off a bit of the boil in ILS, but still some really good deals going through. So I see no reason why these figures shouldn't, again, marginally increase for 2016, but let's see. And of course, it'll take us a while to get back to you on that. So I'd now like to consider some wider issues within the Guernsey insurance sector. turning first to future opportunities, if I may. So I'm relatively optimistic about the future of Guernsey insurance. In the first place, Guernsey is a well-respected and long-established insurance centre. It's multifaceted and generally not based on tax breaks. It embraces several international insurance managers in Guernsey who bring expertise, depth, and international business to the jurisdiction. I think, by the way, we sometimes overlook Guernsey's status. As you know, I chair a body of 19 insurance regulators, small IFCs, and I can tell you that most of them would give their eye teeth to be where we are. It is not easy to build from scratch an international insurance centre such as that which Guernsey occupies. And there are also fewer smaller IFCs who offer insurance than, say, trust business. And with Bermuda being the equivalent now for Solvency II, there are even fewer small IFCs who are also insurance centres who are outside the Solvency II net. So I think that does position us relatively well for the future. Another reason for my optimism is that, unlike for the formal banking sector, the global insurance sector is bound to grow as more and more people become sufficiently affluent to want both general and life insurance products. So IFC should be able to ride on that growth. For example, one forecast sees the Bermuda insurance sector growing at a rate of over 10% per annum, at least until 2019. No reason why we can't do that either. Nevertheless, optimistic as I am, there are some questions, I think, that are lurking in the undergrowth that I think we need to answer before we go forward and maximize these opportunities. And let me go through a few of them to explain what I mean. So one opportunity is for Guernsey insurers to undertake more UK non-compulsory retail insurance, albeit without marketing in the UK. However, were Guernsey to do this on a greater scale, it brings the risk of greater UK focus on our regulatory regime and our lack of an insurance protection fund. I've got no problem with the UK looking at us as a regime, but when someone looks at us, then you have to potentially jump through hoops that they set out. And an allied option following Brexit is to extend our offering to compulsory business subject to what the UK thinks. This, of course, would raise the reputational stakes even higher. Now, I'm not arguing one way or the other here, but I'm just saying that that is an opportunity that brings extra risks, and we'll have to think about that one as we go forward. Now, another example is alternative reinsurance. On the one hand, extending the ILS offering is attractive. On the other hand, this is a risky and still relatively new product, and we need to take care that it is only offered to those customers who understand this, i.e. highly wholesale, basically. I think we do this, but if someone falls down the crack and a retail investor takes this and the ILS proves expensive, then the reputational cost of failure for this jurisdiction could be pretty high. So traditional reinsurance is another opportunity where I think we have a chance. Now, in the past, we have not undertaken much of this business, but recently we have begun to do so in a more material way, and that's great. However, what sort of reinsurance centre do we want to be? On the one hand, we could be a traditional centre on the lines of Bermuda. This direction signals tough local solvency requirements, strong qualitative oversight, and dare I say it, possibly Solvency II equivalence. On the other hand, we could offer ourselves as a lighter regime, aiming at particular in the Asian market. Now, I'm not trying to predetermine the answer to this question. I'm just saying it's something we need to put our thinking caps on and work out, because it's very difficult to go both of those directions at once. Another opportunity is longevity risk, where this jurisdiction is rapidly carving out a market niche. Now, full marks here to the lawyers and the actuaries, as well as the insurance management sector, have worked so hard on this. But even this raises a question. We've got limited resources in Guernsey. Do we have the capacity to maintain our hold on the captive market, whilst at the same time taking advantage of the opportunities here, not least on longevity? If we have to prioritise, what do we choose, and how do we do it? I don't know the answers, but I think they are things we need to think about. Well, as you might expect, now I'm going to talk about regulation. Now, let me firstly say that all these regulations that I've listed here are generally not coming from the Commission. The exception is the Revision of Laws project, where we want to do some tidying up of the insurance and insurance intermediary laws, both of which become a bit dated in places. However, other than this, the regulatory policy channel noted here comes from elsewhere. One such is IAS, the International Association of Insurance Supervisors, and that is the global standard. Now, as you know, some time ago, we looked at the gaps between our policies in Guernsey compared to the new IAS insurance core principles. We then plugged these gaps, for example, with our new solvency approach. However, the ICPs, I would call them, are constantly evolving, not least as they're now being linked more explicitly with COMFRAME, which is the sort of supervisory structure around the ICBs. So inevitably, we will in due course need to undertake another gap analysis, and I expect to plug some more gaps. It's a moving feast, and it never ends. There's another IAS challenge worth mentioning, though it's still some way down the road, and that is the nascent International Capital Standard, or ICS. Now, we don't know the details of this quite yet, but in straightforward terms, it's designed to be a minimal capital requirement for large international insurers. In this sense, it can be seen as the insurance equivalent of the Basel Capital Standard for banks. And like the Basel Standard, although aimed at large international firms, it may become a de facto capital standard for smaller insurance firms. Now, at this point, we will need to think about the relevance of the ICS for Guernsey. I hasten to say, it's not with us yet, it's still being evolved. It may never happen. It may be that the US and Europe will be unable to come to some sort of agreement. But once it's in place, it could potentially be applied here, and we need to think about that. And I have to say that both William and I do come across the ICS in its sort of evolutionary stage, and we're always thinking, so will that work for us, or is that relevant for us? So we are on the case, but it is potentially on the way. Other regulatory challenges come from the United Kingdom, for example, the Insurance Act. This is not the time to debate the pros and cons of the Act, and we had a great seminar with the insurance intermediaries this summer on this exact issue. But the Act creates a degree of legal uncertainty, both because it's new, the last one was the Marine Act of 1901, and because it deliberately creates a more judgmental approach to payouts. So the Insurance Act also creates a modest challenge around the disclosure of risk for company risk managers on captive boards. Now, although neither of these challenges is going to go away soon, the industry is well aware of both these challenges and is prepared to meet them with minimal disruption. But it is an ongoing issue. And another challenge from recent UK legislation is BEPS. Now, feedback from the captive industry suggests that captive industry is fine on this one, as long as it potentially does some more documentation. But again, the challenge is not going to go away. The other issue we have to deal with is the General Data Protection Regulation. Whether it comes from the EU or the States is an issue for you to decide. But we will need to start to implement and think about this, now basically. So I said a few moments ago that the forthcoming regulatory challenges were not coming from the Commission, but from other sources. Now, I'm afraid that I have one more challenge to mention. Most large insurance regulators have by now rolled out their own interpretation of the new IAS insurance core principle on solvency. And recently, for instance, the Geneva Association published a handy summary of them covering, for example, Australia, Switzerland, China, and so on. Now, it's unsurprising that some of these regimes are beginning to ask other regimes whether their approach is equivalent, I use that word carefully, if firms from other jurisdictions want to do business there. We've already seen obvious signs of this around equivalence for Solvency II, fair enough, and equal status in the United States. But basing my views on questions we're beginning to be asked by other regulators, I think we are likely to be asked more and more to justify our insurance solvency regime to other regulators. Well, it's easy if the answer is, well, we do Solvency II or we do the Swiss approach. It's a bit more difficult if you're a small IFC with a bespoke solvency regime. Saying we do the Guernsey approach doesn't quite have that impact yet, however good it may be. So in the future, as an authority, we may be more and more under the microscope to prove not just adherence to the ICPs, but some sort of equivalence to other regimes in undertaking cross-border business. We will have to deal with that. Well, this is quite a list of regulatory policy challenges in the pipeline. Let me make 2 points again. As you can see, these challenges are global. We do not, at the Commission, sit thinking of subtle forms of torture that we can invent for you around regulation. There's enough of that around already. Secondly, we as the Commission are committed to implementing global standards and to ensure, as far as we can, that the Guernsey insurance sector adheres to mandatory laws and regulations. However, we're also here to help you. By this, I mean that we will implement global standards sensitively and in a way appropriate to the jurisdiction. So let me give you an example of this. Earlier this year, we were approached by GEAR, given a draft set of rules on ILS, and asked to implement them. These draft rules were very helpful, but some of them were not written along lines comparable with other Commission policy documents. Fair enough. And in our opinion, some of them were a bit too liberal for our liking. Okay? We were also able to network with other regulators around ILS to understand better their supervisory experience in this area. I think that is something that we can bring. We can usually ring up other regulators and have a very helpful conversation with them, saying, well, how has this worked in your regime? What were the pitfalls you found? That helps us to put in the right regulations here. That's something we do bring to the party that the private sector can't. Anyway, in this particular case, we continued to work with GEAR, and we produced an agreed second draft on the ILS rules, which are now in the public domain, and you're looking at them, and we're getting some feedback from them. I'm not saying we're totally on the same page. It would be very odd if we were. But we've only been able to get this CP out thanks to the insurance industry, but we've also been able to work with the insurance industry to ensure that it is in a regulatory sense resilient. And I think that's an example of how we've worked together both for the private and the public sector. Well, I'd now like to summarize the Commission's insurance work over the last year. I'm glad to say 2016 has not been too eventful for the Commission's work with local and international companies. However, it's not been without interest, and I would like just to summarize developments domestically and internationally. So in 2016, GEAR recommended a radical shift in fees in favor of ILS and at the cost of general insurers and reinsurers. The Commission, we wouldn't have recommended that. It was something that came from the industry. We included this proposal, however, in the 2016-17 fee consultative paper. This proposal occasioned a fair deal of due diligence within the Commission, as well as some negative comments during the consultative process. Nevertheless, the Commission has concluded that this proposal was the right one, and we went ahead with it. I would like to mention, however, just to make this clear, that this fee change does not say that the Commission is anyway endorsing the ILS market, nor, heavens above, should it be seen that the Commission does not want to see growth in the general insurance and reinsurance area. Domestically, we have continued with our routine PRISM work, which is now increasingly established in our working practices. We continue to deepen, in particular, our knowledge and dialogue on both board expertise and business strategy. So 2016 has seen the rollout of our solvency model, both in terms of the categorization of insurer and in terms of the online portal. The latter has inevitably been a bit bumpy at times, not least as this is the first year and the online portal is not yet universally up and running. However, first-year results have not been too bad. I'd like to include a plea here. When your annual regulatory return arrives in the Commission, it goes through an automatic check around certain key indicators. I'm not giving anything away when I tell you that these KRIs include such items as the combined ratio and profitability. It's not unusual for these checks to produce false positives. often because the firm has entered the wrong figures by mistake, say, putting a decimal place in the wrong place. So if your combined ratio is 900%, obviously there's a red light and we look at it, whereas what you actually meant to say was 90%. Online reporting will eventually reduce this problem, but it would help if before you send those forms in, you try to get it totally right, as we are spending too long on false trails. Just to put this in comparative, when I arrived in 2011 in insurance, the waiting time for a low-impact insurance captive in terms of us checking the regulatory returns was 4 years. I do not joke, it was 4 years. Without the online portal, we've managed to get that down to, before we put PRISM and everything in, to about 6 weeks. I want to get it down ideally to about 4 days. That may be a bit ambitious, but that's what automation should mean, perhaps 2 weeks. That means that when we have something through and we do see a problem, we can really deal with it. But it does help to get all the noise out of the way so that we can do that. Going back to our work this year on enforcement, this year has seen no material cases following previous problems around long-term life insurance intermediary. So internationally, Caroline Bradley and Nick Herquin visited the Cook Islands to support insurance supervisors there, funded, I hasten to add, by the Commonwealth Secretariat. And for the group of insurance centre supervisors, GICS, there was another meeting at director level in London this summer. This was almost a full house, and we will hold a December mid-level training session again in London, supported by supervisors from the other Crown dependencies and Gibraltar. I only mention this because when I said it helps to ring up another regulator, and it could be Gibraltar, it could be Bermuda, whatever, to ask how are things going there, how does it work with you, it helps to know personally who you're ringing up. That's why these meetings can be quite useful. And at IAS, Willem has been elected as one of the 2 ExCo members for the offshore region again. I have continued to represent Guernsey on the Financial Stability and Technical Committee. Again, I mention this because this is where the insurance capital standard is being determined. Although I don't pretend for one moment that Guernsey is going to have a determined view in that, it does help us to know where this thing is going if we're going to prepare for it, if it goes anywhere. And Caroline is working on the IAS reinsurance task force. Again, that helps us to position Guernsey for more reinsurance business if we can get it. It also gives us a general idea about business and global regulatory trends. So, what will we be looking out for in 2017? Well, in practice, we'll be dealing with supervisory issues as they emerge, as you can imagine. We are actually mostly a reactive entity, as supervisors inevitably are, much as we like to appear proactive, and I'm sure that's the case for your business as well. Capital and profitability will continue to be a key issue that we will look at in the regulatory process, but it will not come as a surprise to you, especially those of you who were here last year, that conduct issues for insurance are increasingly part of our remit. Are policies easy to understand for the man in the street? Is the charging clear and fair? Is there an effective complaint process? Are policies being sold in line with local requirements? These are the sort of questions we will ask you more and more, and the answers are important. So as I see it, the most pressing regulatory issue in 2017 for Guernsey is the oversight of low-impact local insurance, life and general intermediaries in Guernsey. And we'll be talking about that in the conduct session. And that is where the Commission will be undertaking thematics in due course and subject to resource constraints. However, we will also be considering how best we can effectively supervise insurance managers, given their pivotal significance in the local markets. And we will begin this by applying the PRISM approach in 2017 to some of these firms. Usually in the past we looked at insurance managers for AML CFT. We still do that, but not in this division. That's left us asking, how can we best regulate insurance managers? Again, I've had conversation with my colleagues in other IFCs, and they're not quite sure either. I don't pretend we've got the answer, but we do need to do more about that, because if the insurance managers were to fall down on the job, I'm not saying for one moment they are, but if they were, as you can imagine, there's going to be a knock-on impact to a lot of insurance companies here. So that's why we're going to do that more next year. Nothing to worry about, routine, but I think it would be helpful. So, over the last 20 minutes or so, I've outlined and compared the board composition of the Guernsey insurance sector with banks and with other comparators. I'm sorry it's only been 8 insurance companies, but I think you get the gist. I think it's been quite a helpful analysis. Perhaps you might want to think about longevity in some of the boards. I've talked about insurance trends. I've shown you some good figures, I think, for last year, and no reason why they shouldn't carry on. I've talked about opportunities, lots of opportunities across a very hybrid insurance area, but we do need to think each one through so that we can decide as a bailiwick where we want to go. I've also reviewed the division work in 2016. I think I've given full credence to the work of GEAR and other people in this audience who've helped us with that cooperatively. And I've also talked about the work we'll be doing in 2017. I agree there's still a lot of regulation coming at us. Don't blame us. It's the nature of the world. We're doing our best to manage it as well as we can. So I hope you found all that to be of some interest. Manus, Martin, and I are going to be happy now to answer any questions you may have. And thank you for listening.